Today's critique focuses on a blueprint for a 20-minute script based on the innovator's dilemma, complete with definitions of sustaining versus disruptive innovation, modern examples, and highly actionable deliverables, like a diagnostic checklist and a 30-day experiment plan.
Right, a really ambitious set of deliverables.
Yeah, it is. But to dive right in, the script's selection of modern examples must strictly delineate between radically difficult sustaining technologies and genuinely disruptive ones to avoid muddying the book's central thesis.
I totally agree. Looking at how the script currently defines its terms, there is a real vulnerability in how it approaches that distinction.
Because it falls into that classic trap, right?
Exactly. The submission risks falling into the common trap of using disruption as a catch-all buzzword for any major, impressive technological leap.
Which is completely missing the point of the book.
Right, because the source material is adamant that sustaining innovations can be incredibly radical and complex, yet established firms usually succeed at them.
Yeah.
The true hallmark of a disruptive innovation is that it initially underperforms in mainstream markets. It's typically cheaper, simpler, and appeals to a fringe or emerging customer base.
I'm looking at this and thinking about the common misconception regarding corporate failure. Most people, when writing about this topic, assume these established companies fail because of slow, bureaucratic management.
Oh, for sure. Or arrogance.
Right. Arrogance or executives who are just asleep at the wheel.
But Christensen explicitly states they fail because of good management.
Yeah, that's the core paradox. So how do we make sure the script's modern examples actually prove that listening to your best customers is the root cause of the failure?
Well, to solve that, the creator really needs to stress test and refine the two modern examples they plan to feature in the script.
Okay, so what does that look like in practice?
They have to ensure these examples explicitly showcase an entrant attacking the low end of the market with an inferior but cheaper product.
Instead of just highlighting a competitor with a technologically superior product.
Exactly. We have to completely strip away the misconception that disruption means better technology.
Right, it's not just a shinier new gadget.
No, it usually means worse technology that happens to be more convenient or affordable for a group of people the main industry is just completely ignoring.
You know, the material makes a strong case for this distinction by highlighting the history of the disk drive industry. Let's look at how the script could use that history as a template.
Oh, the disk drive example is perfect.
Yeah, because when the disk drive industry shifted to incredibly complex thin film head technology, which, that was a radically difficult engineering feat requiring massive R&D, the established companies actually maintained their dominance.
Right, because that was a sustaining innovation.
Exactly. Their best customers needed more capacity, so the established firms spent millions to give it to them.
Then you contrast that with what happened when the smaller 8-inch or 5.25-inch drives emerged.
Those were the disruptive ones.
Yeah, those drives were simpler, they had a lower capacity. By every metric the mainstream market cared about, they were just worse.
But they were smaller.
Smaller and cheaper. The established leaders stumbled, not because the new tech was too hard to engineer, but because their best customers, the mainframe computer manufacturers, looked at those small drives and said, we don't want this.
Right, it doesn't hold enough data for us.
Exactly.
So the script could compare its selected modern examples against those historical anchors to ensure alignment.
I think that's a great suggestion.
Yeah, like if the script wants to use a modern software or hardware example, it needs to map directly to how Apple and IBM's early desktop computers were actually simpler and less capable than the massive mini-computers of the era.
Or even the motorcycle example.
Oh, right, how small, cheap, off-road motorcycles from Honda were totally inferior for highway driving compared to a Harley-Davidson.
Right, but they were perfect for a teenager who just wanted to ride in the dirt.
Yeah, exactly.
The steel minimills are another perfect historical anchor to measure against, honestly. The script's modern examples should mirror that trajectory.
Remind me how the minimills fit into this.
Well, the minimills initially produced low-quality rebar, which is the lowest margin product in the steel industry.
Okay, yeah.
The integrated steel giants like U.S. Steel were happy to abandon the rebar market because the profit margins were terrible and it dragged down their overall profitability.
So getting out was a good idea on paper.
Right. By getting out of rebar, the established companies actually improved their financial standing in the short term. It was a financially flawless decision dictated by good management.
And that is the exact mechanism the script needs to capture in its modern examples.
Definitely.
The incumbent's decision to ignore the disruption has to be portrayed as entirely rational. The established company conducts market research, looks at the profit margins of the disruptive tech, consults their highest-paying clients, and makes the correct mathematical choice to walk away.
Which inevitably leads to overshoot.
Yeah, the script needs to clearly illustrate the concept of overshoot, where the established firm's product performance surpassed what the mainstream market actually demanded,
Leaving a vacuum at the bottom.
creating a vacuum at the lower price points for the disruptor to fill.
So, once the script forces the audience to realize that their best customers are the ones leading them off a cliff, the entire tone of the deliverables has to shift.
Right, because diagnosing that you are trapped by good management requires a completely different tool set.
Then just watching what your competitors are doing, yeah.
Which means the diagnostic checklist will provide significantly more value if it focuses heavily on internal resource dependence rather than just tracking external competitor movements.
I mean, that is the core weakness of most of these tools. Tools designed to spot disruption often look outward at startup activity, venture capital trends, or technological shifts on the horizon.
Which feels natural.
It does, but the book emphasizes the theory of resource dependence, the idea that customers and investors effectively dictate a company's resource allocation.
Ah, right.
A checklist that ignores how internal financial systems automatically kill low-margin ideas will fail to spot the most insidious, early structural signs of disruption.
So the threat isn't just the startup in the garage.
No, the threat is your own accounting department.
But wait, if you're a manager or an executive, looking at your own P&L to spot disruption feels entirely counterintuitive.
It really does.
Usually, you look out the window to see who is coming for your market share. How does looking at your own internal budget approval process prove that you're in danger of being disrupted?
Well, it's because of how organizational gravity works.
Let's use that analogy from the text, the gravity one.
Yeah. Historically, when people wanted to achieve manned flight, they looked up at the birds, strapped feathered wings to their arms, climbed to a high place, and just flapped as hard as they could.
And obviously failed.
They invariably failed because they were fighting the fundamental laws of nature. Hard work and big dreams simply cannot beat gravity.
Right.
It wasn't until people actually understood the principles of lift, drag, and resistance that flight became possible. You have to accommodate the forces of nature, not fight them.
And the equivalent of gravity in a corporate structure is the resource allocation process.
Exactly.
Managers think they control the flow of resources, but the reality is that any project that doesn't satisfy the immediate needs of the highest-paying customers simply gets starved of funding.
Because the incentives are all wrong.
Yeah, a middle manager is not going to stake their career, their bonus, or their reputation on a project that promises lower profit margins and targets a market that doesn't even exist yet.
So the script's Am I Being Disrupted checklist needs a total pivot.
How so?
The creator should change it from a standard competitor tracking tool into a rigorous internal audit of the company's own resource allocation processes and customer feedback loops.
That's a great suggestion.
It should force the user to look at their funding approval mechanisms. An outward-looking checklist implies that if you just see the threat coming soon enough, you can rally your existing troops, pivot the massive corporate ship, and fight the disruptor head-on using your current organizational structure.
Which gives managers the illusion they can flap their arms harder and beat gravity.
It does. The gravity of resource dependence means your existing organization literally cannot and will not fight that battle.
The internal systems will reject the low-margin product, like an immune system rejecting a virus. Instead of asking, what are the new startups in our sector doing, the checklist should ask specific, non-obvious internal questions.
Like what?
For instance, are our highest margin customers unilaterally dictating our R&D budget?
Oh, that's a good one.
Or is our mainstream product's performance trajectory over-satisfying the everyday needs of our original tier of customers?
Yeah, checking for that overshoot. We could also look at it from the perspective of idea filtering.
What do you mean?
Another vital checklist question to include would be, do we have well-developed internal systems for killing ideas that promise lower margins, even if they appeal to entirely new or fringe markets?
Wow, yeah. If a company has a highly efficient system for maximizing profitability, they inherently have a highly efficient system for killing disruptive ideas.
Exactly.
Another great checklist question would revolve around financial projections.
Let's hear it.
When evaluating new ventures, are we requiring market-size data and financial projections for markets that do not technically exist yet?
Oh yeah, the book makes a huge deal out of that.
Right. The book makes it very clear that markets that don't exist cannot be analyzed, demanding traditional financial models like a discounted cash flow analysis for a disruptive idea is a guaranteed way to kill it prematurely.
Compared to sustaining innovations.
Exactly.
So, acknowledging that internal financial gravity is really the only way to figure out how to actually achieve flight.
Right.
Once the audience has diagnosed the threat using this internal checklist, they have to execute the response strategy. The deliverables include a decision matrix and a 30-day experiment plan.
Which is where the final major critique comes in. The 30-day experiment plan and decision matrix must explicitly address the structural necessity of matching the size of the spun-out organization to the size of the emerging market.
Right, because framing the response strictly as a 30-day experiment plan without structural caveats carries a major risk.
What kind of risk?
Well, it might imply to the audience that rapid execution within the main corporate structure is enough to ward off disruption.
Oh, I see.
The text warns heavily against this approach. Large, successful companies simply cannot focus adequate energy on small, emerging markets.
Because it comes down to the mathematics of growth.
Exactly.
The book outlines scenarios where a $4 billion company needs an $800 million revenue injection just to maintain a standard 20% growth rate to keep their stock price stable.
That is a lot of money.
Right. But a brand new, disruptive fringe market might only be worth $40 million in its first few years.
Which is tiny by comparison.
Yeah, that fringe market cannot solve the parent company's near-term growth needs.
So a fast 30-day experiment embedded inside a massive corporate structure will inevitably be starved of resources and attention.
Right, because the absolute dollar returns are just too small to matter.
Exactly. The CEO isn't going to care about a $40 million market when they need $800 million just to keep the board of directors happy.
So, to correct this weakness in the deliverables, the script's decision matrix and the 30-day plan must center on creating autonomous organizations and planning for iterative failure.
Rather than focusing on rapid, high-yield commercialization within the existing corporate walls.
Yeah.
Let's look at the decision matrix first to give the creator some concrete examples for improvement.
Okay, hit me.
The matrix must include a critical structural variable. A question like, can our current cost structure sustain profitability at the extremely low margins characteristic of this new disruptive technology?
And if the answer is no?
Which, for an established company with high overhead, it almost always is no. The matrix must dictate spinning out an independent entity or acquiring a small startup.
The script can reference how Johnson & Johnson operates to illustrate this.
Oh, yeah, they are a classic example.
They historically manage growth by operating with hundreds of autonomous companies to capture small markets.
Right.
When a market was small, they addressed it with a small organization whose cost structure and target metrics were perfectly aligned with the size of that opportunity.
Or look at how Alan Bradley successfully transitioned to electronic motor controls.
What did they do?
They didn't try to build the disruptive electronic tech inside their massive electromechanical business in Milwaukee.
They bought someone else?
Yeah, they bought a nascent startup and kept it entirely separate. The small startup was thrilled with the small revenue of the emerging electronic market.
Whereas the mainstream business would have viewed that same revenue as just a rounding error.
Exactly.
I can see how spinning out a separate entity solves the math problem, but I have a pushback here.
Sure, what is it?
Could the evidence also suggest that a 30-day timeline is inherently at odds with how these unpredictable markets develop?
That is a fair point.
I mean, how do we ensure the script frames this 30-day plan as an exercise in learning and setting up the right organizational structure rather than expecting immediate financial returns?
It is a delicate balance.
Because it feels like telling a company to run a 30-day sprint is setting them up for a classic financial failure.
Right, well, you resolve that tension by clearly defining the goal of those 30 days.
Which should be what?
For the 30-day plan itself, instead of outlining a traditional product launch or a race to profitability, the action items should focus entirely on discovery-driven planning.
Discovery-driven planning?
Yeah, it should be about finding ways to fail early and inexpensively. The text explicitly points out that expert forecasts in disruptive markets are always wrong.
Oh, definitely. The disk drive industry is the perfect example of that forecasting failure.
Remind me how that went?
The market analysts were incredibly accurate at predicting sustaining markets. They knew exactly how many high-capacity drives the mainframe computer manufacturers would buy.
Because they could just ask them.
Right. But they missed the 1.8-inch drive market entirely. They assumed those tiny drives would be used in traditional computers and forecasted zero demand.
Wow.
In reality, the 1.8-inch drive created an entirely new market for portable consumer devices. You just cannot forecast a market that hasn't been discovered yet.
That perfectly highlights why the outcome of the 30-day experiment plan shouldn't be, achieve a positive return on investment.
It shouldn't be financial at all.
No, the outcome should be secure an independent budget, establish an autonomous team physically separate from headquarters, and run 3 cheap prototypes that we fully expect to fail.
Right. It's about setting up the laboratory, not curing the disease on day one.
Exactly. The matrix needs to show that you aren't abandoning the mainstream business.
Of course not.
You still pursue sustaining innovations aggressively in the parent company to keep your best customers happy and keep the revenue flowing.
But you place the responsibility for commercializing the disruptive technology somewhere else.
Yes, in an organization small enough that their performance will be genuinely motivated by the small wins of the emerging market.
Yeah, if the script positions the 30-day plan as a structural setup phase for iterative learning, it aligns perfectly with Christensen's findings.
Completely.
You are building an organization whose cost structure is honed to survive on low margins, giving them the runway to wander around in the dark until they find the actual market.
Which is a huge mental shift.
It really is. It forces the audience to confront the uncomfortable realities of how successful businesses actually operate, transforming the script from a good summary of a business concept into a genuinely powerful strategic blueprint.
It really respects the intelligence of the audience while giving them something incredibly tactical.
Okay, let's quickly recap the main points of our critique today.
Sounds good.
First, we discussed sharpening the modern examples to ensure they focus on inferior, cheaper, and simpler technologies attacking the low end.
Right. Ensuring the audience understands disruption is rarely about a technologically superior product.
Second, we recommended overhauling the diagnostic checklist. Instead of looking outward at competitors, it must point inward.
Auditing the company's own resource dependence, P&L statements, and idea-killing mechanisms.
And finally, we highlighted the necessity of refining the deliverables to match organizational size to market size.
Yeah, the 30-day plan and decision matrix must prioritize independent spin-outs focused on iterative learning and discovery-driven planning.
Rather than rapid mainstream commercialization.
Implementing these shifts will ensure the script's deliverables, from the definitions to the checklists and the A/B titles, are rooted in the actual physics of organizational behavior rather than wishful thinking.
We highly encourage the creator to implement these actionable suggestions and warmly invite them to submit their revised script back to us for a follow-up critique. It's only by acknowledging the overwhelming gravity of our own internal systems that we can stop flapping our arms and actually learn to build a machine that flies.